Which business structure is best for tax purposes? Okay, number one, we want to say the first thing you need to look at is whether a particular structure is best from a commercial perspective first. Secondly, we look at the tax benefits of the structure. Now, there's a few structures and we'll just quickly label them or mention them. So first is sole trader. Next one is family trust, also known as a discretionary trust. Then we've got a company. We have a SMSF, which is a self-managed superannuation fund. We can have a JV, a joint venture. We can also have a partnership, which is really a mix of these ones over here. Generally speaking. Now, we did a video about the benefits of a company and the benefits of a family trust, both the benefits and the disadvantages. So have a look at those videos. We'll link them in the description section. Okay, so which of these should we use? Well, again, we need to look at the commerciality of every single one of them first. Sole trader is fairly easy to set up and administer. Unfortunately, it does not have limited liability, which means if your insurance doesn't cover you for a particular incident, creditors or the legal system can potentially go after your personal assets to satisfy a creditor or remedy a defect your business has caused. And so we need to be careful with the sole trader. Also, you get taxed potentially at the highest marginal rate. So it's highest marginal tax rate. Now, we mentioned in the previous video that a family trust does not get taxed. So that's something to bear in mind. It distributes income to various beneficiaries that are somehow related to the principal beneficiary. The family trust, again, is not taxed in its own right. The family trust, the trustee has unlimited liability. So, as mentioned in a previous video, we like to use a corporate trustee to rectify that issue to a large extent. A company has limited liability, but the company is taxed at either 25% or 30% from the first dollar, which if we compare it with a sole trader, the sole trader is taxed on the marginal income. So as the threshold increase, so does the tax on each bracket of the income received. But at the same time, the tax from a sole trader is not capped. It's not capped. It is capped when we use a company. An SMSF is a self-managed superannuation fund, and this is where you grow your nest egg for retirement. A superannuation fund is generally taxed at 15%. A joint venture is really two people going together to achieve a particular ends, but they're not in partnership together. So they work on a particular project, but they're not receiving income jointly. Each one receives income in his own name. They're not issuing tax invoices together, jointly on behalf of that joint venture. Okay, so the question is, which of these structures is best for you? Well, that really does depend on your unique situation and your circumstances, what you want to achieve in the long run and what you have going on right now. Ideally, you would use, again, a mix of these, but that will depend once more on your unique situation and your unique goals. You really need to be working closely with your accountant and tax advisor, business advisor, to ensure you're using the applicable structure for you. It's doing you a great job commercially, and it's also doing a great job for you in terms of saving tax and tax efficiency. Once more, thank you all for watching this video. If you have any questions, feel free to drop them in the comment section. If you have any suggestions, you can do the same. Hit the subscribe button and hit the bell to receive notifications of recent releases of the videos as we post them. Thank you very much for your time.